remember, my career has been largely as a foreign banker, and that too, most of my years I was in trading in currency markets, in interest rate markets, and in derivative markets. So essentially, I was like the dregs of society as far as a regulator is concerned. To be able to get the chance to join a regulator and in a small way make an impact over a larger canvas was an absolute privilege. And I will probably look back upon these 3 years as possibly the most meaningful 3 years of my life compared to all my trading career so far.
It's very special session with us because this is his first time addressing the public after demitting the office. So I think we can be more candid today and we can have a more open conversations even from the audience side later on. So because it's been 3 years for you and you had handled so many different kinds of segments and the kind of experience that you brought in. What was we usually ask the takeaway at the last, but I think for you, this meant to be the first question of what was your takeaway from the regulatory experience as a policy maker from first being the impacted one and then being the one who's making those policies?
No, thank you so much, Khushboo, for having me. And first of all, congratulations to the Business Standard family and community on a very, very successful and I've been tracking this BFSI event for the last 3 days and it's been remarkable. So thank you for making this an annual affair and I hope you continue doing this for many, many more years. So Khushboo, on my takeaways, look, I was incredibly lucky. Remember, my career has been largely as a foreign banker, and that too, most of my years I was in trading in currency markets, in interest rate markets, and in derivative markets. So essentially, I was like the dregs of society as far as a regulator is concerned. To be able to get the chance to join a regulator and in a small way make an impact over a larger canvas was an absolute privilege. And I will probably look back upon these 3 years as possibly the most meaningful 3 years of my life compared to all my trading career so far. I'm not sure everybody else will agree who has been impacted by some of the things that I've done, but at least from my perspective, it's been great. I think one takeaway for me is the following, and if I could pass one message to everybody, those of you who are in frontline businesses in the capital markets ecosystem, it doesn't matter which part of the capital markets ecosystem you are in, please do consider joining policy as a feasible and reasonable alternative. If there is one takeaway for me, we need far more practitioners to make the transition, even if temporarily, to come over to the policy-making side and experience this side. I can tell you from personal experience, the experience was absolutely gratifying for me. The people are fantastic. The team members within Sebi, many of whom you interact with, they are fantastic, very, very talented. It was extremely enriching for me. On the flip side, for this ecosystem to grow, I have no doubt that we need more practitioners as policymakers. So it's not just for the good of you as a policymaker. I think the policymaking ecosystem needs practitioners to come on board, particularly in a place like Sebi. Look at the vast area that Sebi covers, from primary markets, from DRHPs, from merchant bankers, to secondary markets cash, to derivatives, to mutual funds, to brokers, to exchanges, clearing corporations. The list goes on, and each of these areas are very, very niche with a lot of depth required. So imagine making policy if you don't have expertise in each of these areas. And the need for, therefore, people who are experts, who have been there, done that, to be part of the ecosystem is extremely high. So one takeaway for me, please, if you're a practitioner, think about coming to the policy side as a career, even if it's for a few years. And I think for policymakers, it's extremely important that they continue to attract good quality people from the practitioner side to be part of this ecosystem.
Yeah, I was exactly going to ask around that specifically because you are one of the few voices from the private sector, as we call it, not from the rising within the regulator. We have seen how that is also one of the important aspects. It brings in institutional memory and the experience. Do you think there will be more need for, at the top level, to bring in more voices, more experience from the private space, and how open that hiring could be?
I think it's very important. And let me try and give you the full picture as I see it. And you've heard me saying this several times, Khushboo, so you can yawn if you want. There are two errors that regulators can make. The first error, which I call the type 1 error, is when we let bad things happen. So when a Harshad Mehta happens, when a Ketan Parekh happens, when a Karvi broking happens, then when a regulatory ecosystem looks terrible. Everybody looks at a regulator and says, you guys were sleeping at the wheel, tumko kuch pata nahi hai. Whole world knew something is going wrong and you guys are sleeping. So regulators hate type 1 errors. The second error that we can make is in our zeal to prevent type 1 errors, if we come with a 10,000 page master circular that makes life miserable for the practitioner and comes in the way of genuine capital formation by the good guys in the ecosystem, and there are plenty of good guys in the ecosystem, that's a type 2 error. So for a genuine policy making ecosystem, you need to be able to minimize both type 1 and type 2 errors simultaneously. Now, those of you who know statistics know you cannot minimize type 1 and type 2 errors simultaneously. It's impossible. But this is not statistics. This is regulation framing. So the way which Sebi does it, actually, they do it pretty well. They do a lot of consultation, right? They come out with public consultations. Before that, they have advisory committees. Then they have standard forums. There are plenty of forums on which they consult. But to sift through the feedback that comes through the consultation, you need expertise because of a couple of reasons. The first reason, not every stakeholder is adequately represented in the consultation. For instance, I was part of the Mutual Fund Advisory Committee, and I see Rajiv and others here, part of the mutual fund system. When I was a part of the Mutual Fund Advisory Committee, I would always wonder who's representing the mutual fund investor. You hear the voices of the AMCs, you hear the voices of the distributors, you hear the voice of the regulator, but in these advisory committees, who's representing the investor? That is point number one, that you tend to get feedback from the big, the powerful, those who have a voice, and not from every single constituent. The second problem is there is a natural conflict of interest. Take the case of derivatives, your favorite subject. Now, people whom we would get feedback from, brokers, exchanges, clearing corporations, they make 50, 60, 70, 80, in some cases 90% of their revenue and their bottom line from derivatives. Now, even if they're giving you good, honest to heart, good, feedback, the fear in our mind always is, oh, you have a conflict of interest. So when you get incomplete feedback, and when you get feedback that you are worried about conflict of interest, you do need expertise at the deciding level to be able to come up with a rational framework which minimizes type 1 and type 2 errors. It's not easy. It's one thing to say, I will get feedback from experts. But to make sense out of that feedback, remove what is based on conflict of interest, and actually figuring out what is minimizing type 1 and type 2 errors, it requires expertise. And we were discussing this before I came in. You have very, very smart people at policy making and at regulatory levels. But you can't become an expert by purely being a very smart person. You can read every theoretical book on swimming there is to read. But unless you get into the swimming pool and actually start swimming, you cannot be a swimmer, right? So the reality, therefore, is we do need a good mix of practitioners and, of course, people with common sense to be able to sift through the feedback so as to minimize type 1 and type 2 errors. Now, let me come to the other side. The reality is you also need some checks and balances on conflict of interest. So when practitioners like me come into a regulator, of course there will be questions, and there should be questions about what about conflict of interest? Because I've been in private entities before me. I will probably join some private entity later on. So how does one control conflict of interest? There, I think what Mr. Pandey has put together, which is this high-level committee, which will decide what should be the disclosures, how should recusals happen, etc., for code of conduct for whole-time members, for the chairman, for employees of Sebi. I think that is a great step forward to bring in some clarity. Net-net, if we have good ecosystem to manage conflict of interest, if we have a good ecosystem comprising experts as well as generalists who can sift through the advice coming through and arrive at a framework, that is your best bet to minimizing type 1 and type 2 errors.
So you talked about the thin ice that the regulators are walking to not stifle the innovation and everything. And you also mentioned the high-level committee. And earlier in the day, the Sebi chairman said that by November 10, the committee will be submitting the report. So we'll probably get to know how the framework is being shaped about. You called derivatives to be my favorite subject. But yes, one question on the same thing. The data shows that out of all the active traders, investors, only 1.8%, rather less than 2%, are only trading in derivatives, which means even if somebody had certain losses, they could have been offset in the cash market. So how is the data skewed that the survey that we are doing? What more is required? Do we require, what kind of data crunching do we require? Because that has been a constant statement that we really need to look at more data to decide on the derivatives.
So thankfully, I'm answering not as Sebi now, but as a private individual, and this has no bearing whatsoever on what Sebi will do going forward. I think this point I made about trying to minimize type 1 and type 2 errors, I had the privilege of being part of the team in Sebi on multiple areas, on AIFs, on foreign portfolio investors, on derivatives, and on market infrastructure institutions. All these areas was all about minimizing type 1 and type 2 errors. Now, let's take a look at derivatives. Now, what are the data points that got us thinking that we have to do something on derivatives? First and foremost, of course, there were enough statistics showing that retail investors were losing out far more than was reasonable. So, for instance, on 1.8% data point that you mentioned, in FY25, more than 1 crore unique individuals traded in derivatives, largely in index options on expiry day. More than 1 crore individuals. Each of them, on average, lost 1 lakh rupees. The total losses made by the retail investors in F&O in FY25 was about 1.05 lakh crores. Imagine if that money had gone into proper capital formation rather than going into filling up some high-frequency traders' coffers. Now, that was one data point. I'm not saying that's necessarily a data point that we had to act on, but that is one data point. The second data point, which again I've spoken about, was that the volumes that were being traded in the derivative markets, particularly in index options on expiry day, were several times the volumes in the underlying cash market. For instance, even now, in August, data shows that the volume in terms of the delta equivalent or the cash equivalent being traded in the, let's say, the index options on weekly expiry day is 600, 700, 800 times the volumes being traded in the underlying constituent cash markets. Now, this is simply not sustainable. And it gives rise to lots of questions about market stability, about what could happen potentially in terms of volatility and possible manipulation fears. So these were two large areas of concern that we had. The third area was, look, derivative markets, and I've said this repeatedly, is absolutely essential for good quality capital formation. You need derivative markets for price discovery, for market depth, for hedging, for good people, and so on and so forth, right? But there is enough research globally and locally to show that a good quality derivative ecosystem typically has a lot of long-term contracts. 60 to 70% should be beyond 1 month, ideally. In our case, a vast majority of the contracts expires the next week. Forget about, beyond 1 month. So all these were areas of concern. What I want you to, on the flip side, let's go to the flip side. What are the arguments against SEBI intervening? If there are willing buyers and willing sellers, who the hell is SEBI to come and say, no, no, we should change the rules of the game? And that is something we have to be extremely conscious about, that we cannot play God. The second thing to keep in mind, and it's a real thing to worry about, is that whether we like it or not, the ecosystem depends on derivatives for revenues. Brokers, exchanges, clearing corporations, a whole bunch of intermediaries make 50, 60, 70, 80, 90% of their revenue and their bottom line based on the derivatives, particularly index options trading. Now, we had to find a balance between all this. Again, come back to the point about managing type 1 and type 2 errors, balancing and reducing type 1 and type 2 errors. I would argue that if you look at what we have done over the last year, we started the first consultation on derivatives in July 2024. So it's been a year and a few months, almost 1.5 years, since we started acting on derivatives. Very, very consciously and calibrated fashion, right? First circular came out in October, second circular came out in July, or rather in May. So we've taken a very, very incremental steps trying to minimize both. What is our intent? Our intent is to manage the three risks which I mentioned to you, which is retail losses, the instability in the market with very, very high derivative volumes, and the quality of the derivative curve, while managing the fact that this is a free market where innovation should be allowed and where revenues depend upon derivatives. We have to balance all of this. I would argue that over the last year and a half, actually we've taken very, very calibrated steps. The data point we will look at, how are retail losses looking at? How is the market stability looking like? Therefore, is there anything more to be done? And again, it will be on a completely consultative fashion based on the last set of steps, I think, kicked in on 1st of July. There is some more which will happen till December. I'm sure Sebi will probably look at what the impact of all of that is, and then put the data up front and then have a discussion on what do we need to do next.
So fortunately, I think the credit will go to you and your team when India shifted to a future equivalent measure in a more measured way to measure risk in the derivative segment and overall positions in the market. And you talked about capital formation. So earlier, in one of your speeches, you had highlighted the gap between supply and demand in the primary market. So which means the number of IPOs coming and the kind of demand that we have seen. This year is stellar again in terms of the IPOs. But do you see the concerns on the valuations? Obviously, during your tenure only, I think Sebi had taken that approach of allowing loss-making companies to get into the listings. Even if the companies are now profitable, do you see the concerns on valuations as voiced out by many investors?
I'm no expert on valuation, but let me tell you what the data that at least I saw shows. In FY25, the net demand for equities, both in primary and secondary put together, through mutual funds, was 6.1 lakh crores. This is almost twice as high as the previous high that we have seen as demand from mutual funds. If I include beyond mutual funds, also other DIIs, your pension funds, your insurance companies, etc., and individuals coming and buying directly both in primary and secondary markets, that's another 2.7 lakh crores. Put together, the total demand for paper from mutual funds, from pension funds, from insurance companies, and individuals was 8.8 lakh crores in FY25. That's $100 billion equivalent. Okay? Now, this is far higher than the net demand we have seen from these constituents any time else in the past. The net supply in terms of fresh paper, IPO, FPO, rights issues, QIPs, and so on and so forth, all put together, was 4.6 lakh crores. That was also a record. That was also 60% higher than the previous year's record. But the gap between this 8.8 lakh crores and 4.6 lakh crores is also the highest we've ever seen. That's clearly what the data shows. Now, my limited point is, I think particularly in times like this, there is all the more reason that we have to be cautious as an ecosystem. There is Warren Buffett who says that when everybody is greedy, you should be fearful. And when everybody is fearful, you should be greedy. I would argue a policymaker and a regulator should have a similar outlook. When everybody is looking greedy, you should be fearful. So to me, investor education, and I credit to Sebi and Chairman Tuhin Pandey, I think they're absolutely focusing on the right thing. To me, investor education about risk, about asset allocation, about understanding what volatility is, about making sure you have an asset allocation which diversifies your portfolio depending on your risk appetite, all this is extremely important. You know, in the speech today morning, he mentioned 13.5 crore unique investors. I'm not sure how many of them actually understand market risk, actually do asset allocation which is appropriate to their appetite for risk, and have adequately diversified across commodities, across equities, across debt, across fixed income, across real estate, gold, and so on and so forth. Now, there's a lot of work to be done on that front. Now, unfortunately, we don't have a magic wand where all of this can be solved overnight. It's a process. My only request to you as the ecosystem, irrespective of which side of the fence you sit on, I think we have a good thing going on. The fact that so many people want to participate in our capital markets, 13.5 crore people is fantastic. That number can easily become 25 crore in the next 3-4 years, right? It's a great thing. But it is equally important that we should all talk about risk. We should all talk about the need to manage and understand volatility, the need to do asset allocation which is appropriate to your risk appetite. All that should happen. The less we hype up the markets currently, the better for all of us. Do not kill the goose that's laying the golden eggs.
So coming to the point of the kind of capital flow from the foreign markets that we've seen, and under your tenure, we saw relaxations in the registrations for FPIs, new portal, a single window portal that is now coming up. You were also the person who brought in the disclosure requirements, and then there were certain exemptions granted to it. What more is required on the FPI side, and how do we compare globally on the regulations for FPIs?
Look, again, for me, the last 3 years, FPIs was again a great example of having to manage type 1 and type 2 errors. Remember in Jan 2023, we had the Hindenburg report, which raised questions about the color of money coming in through certain FPIs. And it's not the first time these questions have come up. Over the last 30 years, we've often had questions about who's behind a certain P note and who's doing what and so on and so forth. So we had to solve for that possible type 1 error or risk of a type 1 error and have clarity on the color of the money coming in through the foreign portfolio investor regime. At the same time, we could not come out with a regime which was so silly that no FPI would ever come into the country. So we had to balance this requirement for disclosure with a risk-based metric, which was important, which is why we came with this point about only if you have more than 50% invested in a single corporate group, and if you're not a sovereign wealth fund, you're not a public retail fund, you're not a mutual fund, and so on and so forth, only then do you have to disclose, which is a very, very risk-based approach we used to try and address the perception of a type 1 risk, right? Thereafter, we worked hard, as you rightly pointed out, and in fact, Sebi is still working hard on seeing what can we do to make access easier. And there, a lot of things came to light, and we did work upon it. I'll give you an example of the need for expertise and the need for being able to sift through feedback. Do you know that in India, we have T+1 settlement? But FPIs would never get their sale proceeds on T+1. What would happen on T+1 is that their bankers and the custodians would tell them, oh, your money has come to me, but first I need a tax certificate to figure out how much tax I have to deduct before I can send you the money. Which means the FPI would get the funds only on T+2, T+3, in some cases T+4, T+5, after the tax certificate came in. One thing that Sebi worked on, along with the chartered accountants and with the FPIs, was we made sure that the tax certificate would come into the custodian and the bankers by 9 o'clock in the morning on T+1. And we've told every FPI, if you want to take out money the same day, please go ahead. You should get it on T+1. And if your custodian or your banker is saying it's not available, call us. We will speak to the custodian and get it done for you. So the point is that a lot of simple things can be done to to relax and to make life easier for FPIs. One thing we always, and again, credit to Mr. Pandey, ever since he's joined, he's done roadshows in the US, in Asia, as well as in Europe and in London. Fantastic set of meetings that we had where we interacted with several FPIs. A lot of good feedback. There's a lot of positivity, by the way, across the FPI community about investing in India for the long term. But we can definitely do things to make life easier for them. For instance, doing away with the need for wet signatures and apostling of documents. That's something that we are working with RBI to try and see. At least for the good guys, can we do that? Similarly, there are funds that are practically mutual funds globally. So you have funds which are under UCITS in Europe, which are practically operating the way our mutual funds operate, which means they have a blind pool, they have pari passu, pro rata rights, they have an independent fund manager. The question about the color of the money should not come at all for such people. Many of these UCITS funds, they practically have a passport to invest in places like Hong Kong or South Korea or other countries. If you're a UCITS in Luxembourg or in Dublin, you automatically get access to some of the other markets. India can do the same. We can try and give a passport, of course with certain checks and balances, based on a regulatory comfort that regulator gives us, saying that these are absolutely kosher funds, which are public retail funds in the nature of mutual funds in India. Why do we have to subject them to a lot of paperwork when we know they're regulated in their particular jurisdiction and we trust those regulators? Again, it's a risk-based approach that we can use to make life easier. One feedback that we did hear a lot was about capital gains tax for foreign portfolio investors. Now, I know it's way beyond my pay grade, even as a private individual, to talk about capital gains tax. But I do think we have to be very, very conscious of the fact that amongst the large jurisdictions, there is practically no jurisdiction that applies capital gains on foreign portfolio investors. To be a standout jurisdiction like this is something that we have to be very, very thoughtful about. Now, again, it's not Sebi's call, but as an ecosystem, we have to debate this. The Ministry of Finance, Department of Revenue, I'm sure has a lot more data points than I do, but it is something that we have to be conscious about and see whether we can make life easier on that front.
Before I let you go and before you call it end, I must not let you relax before this question. It's one of your recent orders. How closely will you be monitoring that? Now in 2 weeks, it will be again in the tribunal. And what was your feedback? What will be your feedback to the regulator now that they'll be taking up the case? And any learnings from the same? So these three parts.
One innocent question is which order? I signed an order on 9:30 p.m. on 9th of October, which is my last day.
The name that starts with J.
Look, I will not talk about any specific order. That doesn't make sense. But to me, this reiterates the point about why we need expertise, both by way of feedback from the marketplace as well as within the policy-making ecosystem itself. Coming back to your favorite topic on derivatives, do you know that in March 2020, there was a limit which was set on index derivatives, in index options, which was a 500 crore net notional limit. Now, it was set with the intent of trying to minimize the amount of risk that a single person can take. Now, I don't know how many of you actually understand derivatives. By the way, it's a very handful of people who actually understand derivatives. By being within this 500 crore net notional limit, there were entities that were running 5,000 crore, 10,000 crore, 30,000 crore, 50,000 crore short on Bank Nifty stocks, while notionally staying within the 500 crore net limit. Now, that limit was set in March 2020. It was replaced with the delta-based limit that Khushboo mentioned as of July 2025. So for 5 years, we were going with a limit which, with the advantage of hindsight, we can argue was not correct. We need you, the ecosystem, to tell us that, boss, this limit doesn't make sense, because you know what's happening on the ground, rather than us finding out the hard way. And why am I mentioning it? Because when I talked about possibility of, or fear of manipulation or fear of risk, the crux comes down to this, the fact that there were participants who could take such large positions on expiry day in relation to the underlying market size. So it's a conversation that needs to happen. You have to be trusted advisors to us. We have to have the expertise to understand your trusted advice. And collectively, regulations are too important to be left to the regulator alone. Collectively, we have to co-create an ecosystem that minimizes type 1 and type 2 errors.
So I think every time you say type 1 and type 2, I'll take a water next time and I'll be very well hydrated enough. So, but you did not still tell me how closely will you be monitoring now that you have demitted office. Will you be still, will you go in a relaxing mode or will you keep your ears and eyes open for these particular kind of cases?
Look, one should always look forward. Sebi is a fantastic team. They know what they're doing. They will take care of what needs to be done. I don't need to worry about what I've left behind. I'll rather worry about what my future looks like and what I can do for the ecosystem going forward than worry about the past.
We wish you a great endeavor on that again. And thank you so much for being a very lively audience and engaging with us on this type 1 and type 2 errors. Thank you so much.